begin with a question that has haunted investors since the beginning of financial markets. Why do so many who chase quick riches end up with empty pockets, while those who move deliberately and cautiously accumulate genuine, lasting wealth? I've spent a lifetime studying securities, observing markets, and teaching students of investment. And I can tell you with absolute certainty, the path to true financial security is not paved with hot tips, market timing, or the excitement of speculation. It is built, brick by brick, through patience, discipline, and an unwavering commitment to sound principles. Today, I want to share with you the fundamental truths about building wealth slowly and safely. These are not the glamorous secrets that Wall Street wants you to hear. They won't make you rich overnight, but they will do something far more valuable. They will protect you from ruin and guide you toward sustainable prosperity. The title of our discussion speaks of secrecy, but in truth, there is no secret at all. The principles I'll share have been hiding in plain sight for generations. The real mystery is why so few have the patience and wisdom to follow them. Let us begin. The first thing you must understand is that most investors approach the market with a fatal misconception. They view investing as a game of prediction, trying to guess which stocks will soar tomorrow, next month, or next year. This is not investing. This is speculation, and speculation is the enemy of wealth building. Let me tell you about a student I once knew, an intelligent young man, eager and ambitious. He came to me excited about a mining stock that everyone was discussing. "Mr. Graham," he said, "this stock could triple in 6 months." I asked him a simple question. "Do you know what the company owns? What it earns? What it's truly worth?" He had no answer. He knew only that others were buying and the price was rising. 6 months later, that mining company had collapsed, and my student had learned an expensive lesson that I'm giving to you for free. Price and value are not the same thing. The stock market, in the short term, is a voting machine, reflecting the whims, fears, and enthusiasms of the crowd. But in the long term, it is a weighing machine, measuring the true substance of businesses. The investor who confuses these two functions is destined to suffer. This brings us to the foundation of everything I teach. You are not buying a ticker symbol or a chart pattern. You are buying a fractional ownership in a real business. When you grasp this, truly grasp it, your entire approach to investing transforms. Now, let me introduce you to the most important concept in all of investing, the margin of safety. Imagine you are an engineer designing a bridge. The bridge must hold 10,000 pounds. Do you design it to hold exactly 10,000 pounds? Of course not. You design it to hold 15,000, perhaps 20,000 pounds. This extra capacity, this cushion, is your margin of safety. It protects against errors in your calculations, unexpected stresses, and unforeseen circumstances. The same principle applies to investing, but with even greater urgency. When you analyze a business and determine its intrinsic value, the true worth based on its assets, earnings, and prospects, you must never pay the full price. You must insist on buying at a substantial discount. Why? Because your analysis might be wrong. The business conditions might deteriorate. The economy might weaken. There are thousands of factors beyond your control. The margin of safety is your insurance policy against the unknown. Let me give you a concrete example. Suppose you've carefully analyzed a company and determined its intrinsic value to be $100 per share. A speculator might buy it at $100, or even $110, hoping the price will continue rising. But the intelligent investor waits. He waits until that stock falls to $70, perhaps $60, a discount of 30 to 40%. At this price, 3 wonderful things have happened. First, you have room for error in your calculations. Second, if the business performs even moderately well, you'll profit handsomely. Third, and most importantly, you've dramatically reduced your risk of permanent loss. I cannot overemphasize this point. The margin of safety is not merely a good idea. It is the cornerstone of sound investment. Without it, You are building your financial future on sand. This naturally leads us to ask, how do we determine this intrinsic value? How do we separate substance from speculation? The process requires work, honest, diligent work, but it is not mysterious. You must examine a company the way you would examine any business you might purchase entirely. Start with the balance sheet. What does the company own? Buildings, inventory, cash, investments. These are tangible assets you can touch and measure. Then subtract what it owes, its debts and obligations. What remains is the book value, the net worth of the enterprise. But ownership is more than just assets. It's about earnings power. A company that consistently generates profits is worth more than one that merely possesses property. Study the earnings history, not just 1 year, but 5 years, 7 years, 10 years. Look for consistency, stability, and genuine economic value creation. Here's a truth that might surprise you. A business that earns a steady $5,000 per year for 10 years is often more valuable than one that earns $50,000 1 year and nothing for the next 9. Consistency is vastly underrated in modern markets. I remember analyzing a railroad company in the 1930s. Not a glamorous business even then. The stock price had been battered by the Depression. But when I examined the fundamentals, I found something remarkable. The company owned valuable real estate, had minimal debt, and continued paying dividends even in the worst economic climate. The market price suggested the company was nearly worthless. The intrinsic value told a completely different story. Those who had the courage and patience to buy at that depressed price, based on careful analysis, not hope or excitement, were rewarded many times over in the subsequent years. Now we come to perhaps the most difficult aspect of this approach: patience. In a world that moves faster each year, where information arrives instantly and trading happens in milliseconds, the virtue of patience feels almost quaint. But I assure you, nothing has changed about human nature or about the fundamental principles of value. The investor who cannot wait, who must act on every piece of news, every price movement, every tip, will inevitably make costly mistakes. Building wealth slowly means accepting that opportunities don't arrive on your schedule. It means having the capital ready and the temperament steady, so that when genuine opportunities appear, and they always do, eventually, you can act decisively. I've known many investors who understood valuation perfectly, but failed because they lacked patience. They bought good companies at fair prices instead of waiting for excellent companies at bargain prices. Over decades, this difference compounds into something enormous. Think of patience as a filter. The impatient investor considers hundreds of potential purchases each year, making frequent trades, incurring costs and taxes, and exhausting his emotional energy. The patient investor might make only 2 or 3 significant purchases in a good year, perhaps none in a poor year, but each purchase is made under favorable circumstances, with the odds tilted strongly in his favor. Which investor do you suppose sleeps better at night? Which one builds lasting wealth? The stock market is designed to transfer money from the impatient to the patient. This has been true for centuries, and it will remain true for centuries to come. Let me address something that troubles many who first encounter these ideas. They say, "Mr. Graham, this sounds extremely conservative. Won't I miss out on the big gains?" Here is what I tell them. The primary goal of intelligent investing is not to achieve extraordinary returns. It is to avoid serious losses while earning adequate returns. Notice that word, adequate. An adequate return, consistently achieved over many years, with minimal risk of permanent loss, will make you wealthy. It will secure your family's future. It will provide for your retirement. It will grant you the financial independence that so many desperately seek, but few achieve. The investor who reaches for spectacular returns typically ends up with spectacular losses. We've seen it repeatedly throughout history. The bubbles in railroad stocks, in utilities, in technology companies. Different eras, different industries, but always the same story. Euphoria followed by devastation. Safety doesn't mean avoiding all risk. It means taking calculated risks when you're being paid handsomely to do so. When the margin of safety is substantial, when the price is far below intrinsic value, when the odds are overwhelmingly in your favor. I've often said that the defensive investor should never forget that he is purchasing ownership in a business, not a lottery ticket. Would you invest your life savings in a local business without examining its books, understanding its competition, and assessing its prospects? Then why would you do so with a stock? The safe path is the analytical path. It is the path of careful study, conservative assumptions, and disciplined patience. It is not exciting. It will not make you the center of attention at parties, but it works. Decade after decade, in good times and bad, it works. My friends, we've covered substantial ground today. Let me leave you with the essence of what we've discussed. Building wealth slowly and safely is not a compromise or a second-best option. It is the only reliable method that has stood the test of time. It requires you to think independently, to resist the crowd, and to maintain your discipline when others lose theirs. The principles are simple but not easy. Buy businesses, not stocks. Insist on a margin of safety. Determine intrinsic value through careful analysis. Be patient. Think long-term. Protect against loss before seeking gains. I cannot promise you that following these principles will make you the richest person you know, but I can promise you something more valuable. You will sleep soundly at night. You will avoid catastrophic mistakes. And over the years, your wealth will grow steadily, safely, and surely. The crowd will mock you for being too cautious. The speculators will laugh at your slow progress. Let them. When the inevitable storms arrive, and they always do, you will be standing firm while others are swept away. This is the secret that isn't a secret at all. It's simply the wisdom to distinguish between price and value, the courage to stand apart from the crowd, and the patience to let time work in your favor. Invest wisely, build slowly, sleep soundly. Thank you.